The basics of Forex Part 2. We will be diving a little deeper into the daily terminology used in the Forex market. The foreign exchange market shows the exchange rate between two currencies. Traders and investors make money in this market by the change in the exchange rate by placing either buy or sell orders. So let's look into what exactly is an exchange rate. An exchange rate is the value of one currency relative to another currency. In our example, we will use United States and Europe. Let's say we travel from the United States to Europe and we need the domestic currency to conduct any transactions in Europe. So we go to an exchange booth or counter and exchange our dollars for euros. At the time of the arrival, let's say $1 is equivalent to €1.09. When we are headed back home after our vacation, we want to exchange the euro for dollars again. So we go back to the same counter and give our euro in exchange for the US dollar. But because exchange rates are constantly changing, now our €1.09 may be equivalent to more than $1 or less than $1 depending on the strength of the US compared to the EU. As a Forex trader, we capitalize off this change in exchange rates. We predict the change in the exchange rates for the two currencies in the coming hours, days, weeks, or even months, and if our prediction is correct, then we earn a profit. If our prediction is incorrect, then we may incur a loss. In the Forex market, we don't say the market changed by X amount of exchange rate. Instead, we say the market moved by X amount of pips. So what is a pip? A pip is a unit of measurement that is used to express the change in the exchange rate value of a pair. It is the last decimal value of a price quote. For majority of the pairs except JPY pairs, we use the value in the fourth place after the decimal to determine the pip change. In our examples here, let's say GBP USD changed from 1.4024 to 1.4026. Then we would say GBP USD moved by 2 pips. In the case of a JPY pair, we would look at the third decimal spot. If Euro JPY changed from 115.320 to 115.325, then we would say Euro JPY moved by 5 pips. Oftentimes, you may see a fifth, or in the case of JPY pairs, a fourth digit on your trading terminal. That is a pipot, also known as fractional pip. The pipot in the buy and sell prices display the spread value, which we will discuss in the next video. But distinguishing a pip from a pipot is essential for understanding the spreads. When trading on platforms such as MetaTrader 4 or 5, you may see something similar to this picture. The pivots are shown by the small fifth value after the decimal. The next terms on our list are base and quote currencies. The first currency in a pair is known as the base currency, and the second currency is known as the quote currency. The base currency represents how much of the quote currency is required to purchase 1 unit of the base currency. We will use AUD USD as an example. If the exchange rate for AUD USD is 0.76, then that means to purchase 1 Australian dollar, we need 76 US cents. Then we have lot sizes. A lot is the size of transaction a trader is entering in a position. The lot sizes vary from a nano lot, which is generally a penny lot, meaning you are investing a penny, and the lot sizes can go as high as standard lots. When you enter with a nano lot, you are buying or selling 100 units of a currency, depending on your position. And we will dive deeper into how to calculate your lot sizes when we discuss risk management. But as a rule of thumb, I abide by risking only 1 to 3% of the account balance. So with an account of $100, this can range from a nano lot of 3 cents to a micro level of 30 cents, depending on the trade. We will discuss these factors in the risk management section. Please comment below what other topics you would like me to cover in this series, and if this series is helpful for you so far.